Hi everyone, and welcome to this live webinar. Hello Annie, hello Adinda, nice to be here with you guys also. My pleasure to be here with you again. Hello, okay. And as you know, we are going to start another webinar of the Beginner's Corner. The idea, as you may all know, is to talk a bit about some technical, some basics over the market. I hope I can add something to your knowledge with all the videos we are doing, okay? And finally, we are going to left the last 15 minutes for different kind of questions if you have some, okay? Anyway, and today the idea is to start talking a bit about indicators, technical indicators and oscillators. We are going to focus mainly on moving average today. The idea is going to talk and discuss and see the utility of every single indicator over the upcoming sessions. Of course, we are not going to talk about each one, right? There are thousands of indicators. The idea is to talk about the most important and set what kind of information they give. As you all may know, a technical oscillator or indicator, right? It shows the graphical representation of a mathematical relationship, right? Between the most important variables we have in here, time, price, okay, the two central axes, of the Forex market. Of course, that depending on the trend, change of way, or breakthrough, then to determine reference lines, show us the moment of buying or selling a determinate currency pair, in this particular case, commodities, stocks. Keep in mind that all technical analysis has been in primary developed for stocks, right? But we call oscillators the one that had only variations from 0 to 100, right? The ones that are limited, like relative strength index, that fluctuates in between 0 and 100, right? And on the contrary, we call technical indicators the one that have no parameters to limit the in the signal. The main advantage of these technical indicators or oscillators is that they are very easy to use, right? The fact is that at the same time, they give us a reliable font to base our selling or buying decisions, as their signals are clear and concrete, right? That's why we believe any valorization, especially at short and medium term, must be complemented with these technical tools. Of course, nothing of this is worth it if we don't backtest indicators, if we don't study their reaction of a certain pair with a certain indicator, and if we don't have a trading plan in which we are based, right? So, regarding the kind of technical indicators and oscillators we have in the Forex market, right? You know there are thousands. As I said, every day a new one is created that disappears as quickly as it appears. There is no thing as magical, technical, universal indicator, right? That it will be valid for any kind of title, currency, commodity, or market situation. And that's why it's important to use more than one to valorize the good, or in our case, the currency pair in a certain moment, right? Anyway, these tools can also be classified as open or closed regarding if they could be measured in a 0 to 100 scale, like the oscillators, right, or not, and also related to cycle or trend, and if they are more useful in one or in another situation. Honestly, I do believe that we should base over all our trading strategy in at least two different views of the market. One, using the kind of technical indicators that help us when we are in a clear trend, and the other one is to use the oscillators when we see a lateralization or consolidation stage in the market and we are lacking definitions or trends. I usually have my settings, right, for certain market conditions. I have my settings saved in MetaTrader. So if I see that the market is not trendy, then, well, I will just change the settings of the certain pair and apply my sideways market strategy, right? I don't believe there is one single strategy that can be useful, or at least that will be profitable in the same way from different pairs. Despite there are strategies or technical indicators combinations that could be profitable, right, for almost any currency under study, the fact is that if you test them on different currencies, you will find out that some are better than others and some are worse. That's because we have several factors, several parameters that these indicators may not be measuring. And that are, for example, right, the intraday volatility. If you take a look, I don't know, dollar Japanese yen lately, that we have been trading in a 40 pips range for at least 2 or 3 weeks, right? What kind of technical indicator, or how could I be intraday or short-term profitable trading a pair like that? It's not the system. It's also the behavior of the currency pair under study. And that is something that we sometimes forgot to take into account. Different pairs have different behavior, okay? And market conditions, for example, I don't know, risk aversion, commodities prices, are also pushing a certain currency higher or lower against the rest of its pairs. So those factors are not always considered by this technical indicator, right? And we could not ignore that condition. That's why it's so important to take a whole look at the market. I don't know, if we talk, for example, about relative strength index, right? That is an indicator that tells us where or when a certain currency pair is overbought or oversold. If you take a look at Swiss franc with relative strength index, you will see that the Swiss is overvaluated, yes, against the dollar. It has been that way for a couple of months already, and that's not something we should understood as a reversal or bottom, because bottom should have been set a couple of months ago, right? And we have lost a good number of 100 pips since then. So we cannot measure the market or the certain currency pair just with one single indicator or even not a couple. The idea today is to discuss and understand what are the uses of the moving average, how we can use them, and how we can combine them between each other or with technical indicators. But keep in mind that there is not a single trading strategy that we can call 100% perfect. Okay? Anyway, to start a bit of talking about this moving average. What is a moving average? I believe that it's a simple concept that we all do understand. I'm starting with one single, I forgot that. With one single moving average, one single chart, we have euro dollar in the yearly chart with a 20 simple moving average. And of course, this simple one, the most common we use, and the one we call simple, right? It's just an average, okay, of the price of the value over the next number of sessions. In this particular case, 20 sessions. This is the 20th simple moving average. So these are trend direction indicators that calculate a simple arithmetic average of price for a specific period, showing the average value of the price on that certain number of days, right? The simple one is the one that does not add anything else to that average. We have then the exponential moving average, the smooth moving average, the linear rate moving average. There are different types of moving average. We're going to go adding one, another 21, but this time we will set an exponential one in crimson, okay? As you may see, the exponential moving average smooths a bit the simple one, right? By adding to current closing price, meaning the latest one, right? The previous value, and giving the last price more weight, right? That's why they are so fast, or they are faster than the simple one. As you may see, it has turned lower pretty earlier than the other one, right? And it's below the simple one. So the only difference in between a simple and an exponential one is that the exponential gives a bit more weight on the latest price, right? the latest information with the idea, right, that recent behavior will continue, okay? If we are talking about the 20 periods, well, there's not going to be so much difference. But if we're going to talk about bigger moving average, say in 50, 100, 200 periods, then you will notice that the difference in between a simple and an exponential one is a bit bigger, okay? Then we have what we call the smooth moving average, right? The side I have just said that the exponential smooth, we have another one that is the smooth moving average, right? But this one gives recent price, right, the same weight as historical one, right? It's slower, in fact, the slowest of all the moving average, and I usually recommend to use it with long-term periods to get better results. Honestly, I don't believe in the short term, like 20 or 50, or using a moving average of this length are what when we are talking about smooth, okay? It's also smooth prices, but it gives all an equal weight, right? It makes a balance in between the numbers it averages, making it a bit slower. And finally, we have the fourth moving average, the linear weighted, right? That it's a kind of, let's see, orange, okay? The orange one. It is pretty much like the exponential one because it tends to smooth the simple moving average, right? By giving, again, the latest data more weight value than to earlier data, right? It's just in a different way than the exponential one, because in the exponential one, it's proportional, the weight it gives to the different values. In this case, it accentuates, right, the weight in the latest price. And it's, of course, the fastest, right? But it has not much difference with the simple one. Anyway, keep in mind one thing. This moving average, right, work better in trend markets because they are trend followers. Indicators are most of them trend followers. None of us. None of these is very useful as an advanced indicator, at least the classic ones, right? But despite being just a trend follower, okay, it will help us to let wind flow, right, and cut losses time. Because if I know that tends to be messy, but if we know that we have a general bullish tone in the market and prices hold above the moving average, right? The moving average keeps heading higher, and I'm inside the market. Well, the fact that the slope is heading higher is helping me to let my wings run, right? When it turns flat, it's usually a sign of warning, right? When the moving average turns flat, it's telling me two things. Either the market is exhausted, right? And it's, of course, entering the lateralization stage, or that it's done reverse. So I will be able to cut my losses on time also, just taking a look at the moving average. I know it sounds easier than it seems. It's not such an easy exercise. But the fact is that when you get used to the correct moving average in the correct pair, in the correct time frame, you will discover that it works to take a look at it for trading and letting profits run and cutting losses earlier, okay? Besides, remember the short-term moving average, like 10 or so, are good for intraday trading or short-term trading, right? If you're a medium-term trader, then don't go anywhere below 50, okay? I could say maybe 40, 80, that will be the range of the moving average. And of course, to analyze long-term, meaning daily charts, weekly charts, I suggest that the best is to use 100 moving average or even bigger one, okay? They tend to be more reliable. The length of the moving average should be related with the time frame or the term we are trading, right? If I want to trade daily chart and I'm thinking, I don't know, that euro will fall to 130, right? I could not base my trading decision in a 20 sample moving average that is giving me the information of the last 20 days. I need the information of the last 100 legs at least to be sure that my analysis is pointing in the right direction. Okay? Anyway, and when it comes to this moving average, we can give them different use. One of them is use them to trade, right? And the other, of course, is a dynamic support or resistance area. When coming to trade with moving average, I believe that the simple way to do it, right, is using a moving average breakout, right? In this method, you have to draw moving average, right, in the middle of the chart, like in this particular case, a 20 symbol one in the 1 hour chart, the blue one. And when the price crosses the moving average downside up, and there's a new candle opening above the moving average, I will be able to buy, right? And on the contrary, when the price crosses to the downside and I have a candle opening below, I will be able to sell. However, I don't believe that this is much more reliable, right? In this particular case, we have a candle opening below the moving average, and of course the price reversed it, right? Again, here we have a movement. Well, this one seems a bit more profitable. In this case, we have an opening above, some pitch to the upside, but in general, it's not enough one single indicator to talk about trading or a trading strategy, right? You cannot base your trading decision in just a moving average breakout, right? What we can do on contrary, right, is use moving average crosses. I know there are different theories about this and several ones that use 2 moving average. I tend to use 3, right? Because I find out that 3 made it a bit more visual. As you can see in this chart, I have 3 simple moving average in 3 tones of green. The lighter one, okay, is the 4 periods, 1, 4, 9, and 18, right? 4, 9, and 18, where the first one will be set with the smallest period possible. In this case, it was 4, because it's a fast moving average. And the idea of that one is make visual the price action, right? Because if you just leave the 4 or 3 or 2 moving average, then you will see that it's just in the middle of a candle, right? It's not me much more information than that where the price is. It's just price considering the 4, right? But the use of 3 moving average is better than the use of 3. Why? Because when price action, or the shortest one, cuts the 9 periods one, right, it's giving me a first warning of a probable signal or market entry, right? And when it finally crosses the second one, sorry, the larger one in this particular case is, it's confirming me the signal, and it's giving me a more clear visual way to see that the market is giving me a selling sign, right? Of course, the fact is that when we have the 4 in this case cutting the 9 and the 18, and then we have 9 cutting 18 back, then that is confirmation that I'm in the right side of the market and the price will probably go my way. The fact is that I will try to enlarge it a bit, okay? When on contrary, the 4, if I'm selling, I have been selling a certain pair, right? And when the 4 cuts back above the 9, in the contrary way I am in the market, right? That will be my exit moment. This was not what this one was. Anyway, that will be my signal to close or take profits, because it's telling me that there is a good chance price will probably go in the opposite direction. Okay, and in fact it did. I know I did not choose the best pair for this example, as Valeria Bednarik has been moving a very tight range. But what I like about this particular cross is that if you take a look, it works pretty well with this 4, 9, 18 period, right? In the 1 hour, in the 4 hour chart, even better, okay? And you have clear examples how, as long as moving average are in the right side, right? And despite some price spike, the trend tends to continue, right? Until we have the final reversal when the shorter one, the 4 periods one, cuts the 9 and the 18, right? In general, when we talk about moving averages, crosses, right? What would you consider a good cross or golden crosses with that usually? Well, be sure this kind of moving averages all introverted and mostly flat and cutting each other. That's not the best one. The signals, the good signals are this one, right? As more vertical, the better, right? Make this one also consider a good one, or this one, right? Or this line one. Not this one when the moving averages are mostly flat, hovering one around the other, and we have not a lot of definition. We have no slope, right? The slope of the moving average, when performing the cut, should be at least of 45 degrees, right? Keep that in mind. I know we are not going to measure the degrees of the angle when we are trading, but keep that in mind when you see a moving average cross that to confirm either if it's a cross or we are in the middle of this noisy movements the market tends to do, right? Another way of combining these three moving average, another strategy that I find pretty much reliable, right? A bit more less. We have less signals in here, but they tend to be also pretty good ones, right? It's using more or less the same system, but with 5, 13, 55, right? In this case, as you can see, we have 3 different purples, right? And this one, in this particular case, they are exponential moving average, not simple ones. I found that it's quite profitable to tell me where the trend is, mostly in the dollar, Swiss franc, dollar, euro, dollar, GDP, mostly the greenback against all European majors, right? And if you take a look, you will see that even the moving average tends to act as dynamic support for the cross in several occasions, and it's pretty trend follower, and it lets you ride your wings pretty good. Keep in mind this one is exponential 5, 13, 55. It's this particular system, okay? Anyway, and when it comes to another way to understand moving average, and I believe that I share this with you all daily, but I believe it's worth to record it here, right? Is using the exponential moving average or even the simple moving averages as dynamic support from the system level. I have chosen the pound dollar because I believe it's the one that mostly and more perfectly reacts with moving averages. In fact, pound is a very technical currency, right? The pound dollar is one of the most technical pairs. Anyway, as I was saying, and a way to use the exponential moving average, not only as signal triggers or crossovers, is to use large ones, 50, 60, 100, 200, as dynamic supports on the resistance area for the intraday trading, okay? That's why I take a look at the 4-hour chart. In fact, if you will look at my chart, you will find out that I have this purple 200 exponential moving average in almost any probable process except Japanese Yen 1. I found out that it's not too much reliable. However, I only take a look at this moving average in the 4-hour chart. I only take a look at this moving average as dynamic of resistance, dynamic support of resistance level. I'm not using this moving average for mostly anything else, but to set probable targets, probable areas of reversals. Anyway, what we use always is support or resistance, right? Keep in mind, of course, that we are talking about a dynamic indicator, right? As days go by, number change because it's a dynamic one. It changes, right? Price falls, indicator also falls. So where I use this moving average, right, is to check them in a 4-hour chart. With observation, you will find out that generally prices rebound or stop or halt their rallies pretty close to that moving average when you're trading morning time frame. Meaning, if we are close to the moving average, like we have been over the past few days, okay, well, I have set the point where the moving average was intraday and take that as an support or resistance area. If you take a look at the pound, the 4-hour chart, you will find out that it always struggles around this area, right? It's in here, of course, as any support or resistance area, okay, it's, at some point it's broken, right? But see how many times the pair tends to halt around that level, right? Once it's broke, it's a resistance, right? It's the downside. Once it's broke to the upside, it's the support. And the same with this 200 exponential moving average goes for our friend the euro, right? See how many times prices has halted near it and bounced it lower or higher, depending on the side of the market we were before break, right? But it generally, when the pound dollar price reaches this area, it's a conflict time, right? We know that there's a high chance to see the pair rebounding or retreating, right, from that area. So if we are already inside the market, well, then it's a warning that's telling me, okay, here it is, take your profit and run away because the market won't continue and there's a high chance of a reversal. I know maybe it's not the best trading strategy or trading signal you may find, but knowing where to exit a trade is as important as knowing where to get into a trade, right? When people always, we traders, always forget that a trade has three extremes, right? A trade is not only an entry point, it's an entry point, an exit point, and a stop loss. We never should forget about that. Anyway, so that's how I use that 201, okay? Take notice that usually when this moving average is broken, okay, let's say for more than 80% of the pips of the currency and the study, in this particular case, the pound, okay, I would say in 8% of the pips the pair moves today, that probably means a change of status, a change of trend. If it was a support, then turns into resistance. It was a resistance, it will probably turn into support and strong one, right? Can last 1, 2, 3, 10, 1,000 candles. Another way to take a look at this moving average for me, right, in this particular case, is the distance and the slope. The distance from current price, as long as price keeps moving away from the moving average, okay, more bearish I will be in the pound. And of course, if the slope of the moving average keeps turning lower like it's doing right now, well, then more chances of further falls in the price, okay? It's a trend follower, but also a trend definer for me and the way I am used to take a look at it, okay? And most or pretty similar happens with the 20 simple moving average for the pound. And this applies also to Australian dollar, right? I tend to watch the behavior of the price, right, regarding the 20 simple moving average. When we have a break of the 20 simple with a candle with this high volume, right, it's usually a sign of a continuation either side of the board, right? Bullish, bearish, in this case, bearish. But pound particularly always tends to halt intraday near the 20 simple moving average. If you turn to the hourly chart, you will find that it also tends to do so, right? Find dynamic support or resistance in the 20 simple moving average. So it's more like a guide, again, not a trading strategy, not a way to trade the market, but a guide to tell you what price may be doing next. That is what we are always wanting to know, right? When the price reaches the moving average, it halts. No matter what, it halts. I have seen this happening even in smaller time frames. But just take a look at the 1 hour chart or the 4 hour chart. Smaller time frames are not that valuable. But it's also a place where the price will halt its run and start hesitating. In fact, even in the daily chart, you will find that intraday talking, right? If we have the moving average at a certain level, near current price, there's a good chance that price will test that level and bounce. Of course, again, as every moving average or any other static support or resistance area, some moment is broken, right? But see how many times pound tends to have its rally or bounce back from the 20 simple daily one. Okay, so keep that in mind when trading when using moving average. Anyway, one more thing. As I told you, just one indicator, just 2 or 3 moving average are not enough to trade a market. However, I don't also consider very smart to use more than 2 or 3 indicators. I tend to use for myself moving averages and then add a trend indicator, something that tells me where the trend is, and some sort of cyclic indicator to tell me if we are reaching extreme oversold or extreme overbought conditions. I believe that that's the scheme, right? Not more than 3 indicators are just enough. If you plot more than 3 in your chart, then you will find out that there are several times when one of them, of course, will be heading in the wrong direction, right? So it will make more difficult your ability to take the decision to trade. And we need that to be as simple as possible. 2 indicators, 1 moving average, some support, not much more than that. The fact is that no matter what system you use to trade or what indicator, remember that these are just tools, right? The most important thing is here about any kind of technical indicator is doing your own back testing and try to keep it as simple as possible. If you do your own back testing, you will feel confident. As you understand better the currency's behavior and what you are actually doing with getting into the market, right? It's simple, and you don't have to get dizzy with 1,000 kind of signals. If you have the ultimate expert advisor that gives you signals, right? And the ultimate trader expert advisor tells you to buy euro around 42.40 today, right? And the ultimate expert advisor, sorry for the insistence or the indicator, not for expert advisor, tells you that you will win 100 pips with that. What will you do if you have already bought euro around this level now that it's almost has lost almost 100 pips, right? What happened? Where did you put yourself? What? Right? Why? Because you don't know what you're doing, or the indicator is doing, or the ultimate expert is doing, right? You will be shaking and tumbling, okay? Not sure if to close the position, to wait till the market reverses, or whatever. If you do your own back testing and you understand what you're doing, and you understand that the price or the entry was a fake one, a fake signal, a bad entry or whatever, you have been long closed your trading position, right? Assume a small loss and move on with your life instead of being stuck inside a trade waiting for the reversal that may never happen. Okay? Anyway, okay. We have a couple of questions. I will start with Archinga. How can you know when a trend price starts moving in opposite direction, if it's a reversal or starts a small pullback? Well, what's a good question, and that will depend on I believe that is the easiest way to determine so, right, is first of all, have a concept that, let's use the simplest and greatest tool we have, right? We have been seeing euro fall, right, in the short term. It starts moving upwards, right? That means I need to move into the market and buy right away or sell right away? No. It's telling me that at least a corrected movement is starting. How do you determine if it was a correction or if it was marked or if it's a reversal? Well, the 61.8% of Fibonacci tends to be the mark, right? If the PR or the price action overcomes that 61.8, that suggests a reversal. So there is a good chance that price would have reached at least reach this area again, the 100%. Okay? That will turn you into a reversal. As long as not above this level, you should understand that it's a corrective movement and that the bearish dominance or previous trend will resume any moment. Okay? Like in leading back up here. If you follow my reports, my daily reports, I use this 14.6% as a thermometer, right? As once the corrective movement starts and it can opening above that 14, I was actually expecting the correction to extend at least to 38, and in fact it did a bit more. But having not break above the 61, then correction and no reversal. And having break back today below the 38 that has been acting even as a resistance area, well, more confirmation that more bearish pressure may be seen, okay? We are going to continue next Friday talking about some more technical indicators, okay? Mostly the trendy ones. I would like to share with you a lot about momentum and ADX. We're going to take a bit more than today, hopefully. So I hope to see you all there. Have a great and amazing weekend. Okay, see you back on Sunday with Market Sunday opening, and enjoy your weekend. Okay, thank you for being here, and bye-bye.